Hi, I am Mr. James, and welcome to another of my accounting tutorials. Today we're going to take apart Accounting Unit 1, 2016, Paper 2, Module 3. Let's get right into it.
We have here before us a statement of comprehensive income for Ralph as sole proprietor as Farmers Mart, and we are required to prepare a statement of cash flow for the year ended 31st December 2015. In addition to this, we have statement of financial position as 31st December 2015 and give us comparative statements, the balance sheet. Okay, I have already read it. You will take your time and you will go into it and read it. We also have a statement of changes in owner's equity for the year ended 31st December 2015 and some additional information. I will read through the additional information at the bottom because I will not be flipping back to it. So from time to time, you will pause the video and you will look back at this information to see what I'm working on. During the year, equipment with a book value of 65,000 was sold for 40,000. The loss of sales was included in the administrative pages. Now I put it just as it is in the was in the past paper. The loss of sales. It should be the loss on sale of the fixed asset of the equipment, right? Selling expenses include an annual depreciation charge of 53,400. A piece of equipment valued at 143,600 was purchased during the year by check. Current assets at 31st December 2014 includes a cash at bank of 45,000. So this here gives us the opening balance for our cash. There are some workings that we should always do before we start our cash flow statement. Okay, now it may appear to take a long time, but once you get all the workings done, and all you have to do is write up the cash flow statement. Once you are acquainted with the format, then you have no problems. The writing up of the statement itself may take you just a few minutes, and but your workings could take you a good 20 minutes or so. That's quite all right. Okay, the first one we need to look at is the profit before interest and taxes. This is the figure that you would start the first section with your operating activities. You take the net income and you add back the interest and the taxes. In this problem, we don't have any taxes, so we just add these two, and this is the profit figure that we will be starting with, 45,750. So let's look at the next work. Our next working is the loss on sale of asset. To get that, we take the net book value of 65,000. At this stage, you may want to look back and see these in the additional information. Proceeds 40,000 and we get the loss of 25,000. So let's take a look at the other weekend. In the current asset, the total on the first balance sheet 98,400, and then from the previous year's balance sheet 2014 68,900. So we get an increase of 29,500. Okay, this would go into our cash flow statement. The next working we look at is the non-current asset account, and it's at book value. So that takes into consideration the depreciation itself. So at this stage, you may want to pause the video and verify these figures from your information on your balance sheet and your comprehensive income statement and the additional information. Okay, so you notice the balance brought down is 275,800 and the balance carried down is 306,000 from the two balance sheets that are given. Right, the disposals was 65,000 for net book value. Depreciation was 53,400. right? We are told that we bought some additional equipment for 143,600 paying by check. We are not told about this figure here, but if you draw up the account, and that's the only way you would see this. If you didn't draw up this account, you would not see this figure, 85,000, that you're purchasing fixed assets or non-current assets with. It's a balancing figure in this account to make it balanced. Okay, and incidentally you would notice it's the same amount as the capital introduced, which means he would have taken his private money, bought the equipment, and thereby introduced capital at the same time into the business. Okay, so this would be under your investing activities too, together with the other purchase of the equipment here. We will now look at the cash flow statement, and I have the three sections in three different slides because they couldn't fit on one slide. Okay, so afterward we'll add up the three different sections in this column here and get our reconciliation. All right. So the net income before interest and taxes was 45,750 from our workings. The depreciation from the additional information 53,400, and the loss on sale of fixed assets have been from our workings 25,000. These two we add them back because they are not involving the movement of cash at all. They are notional figures just calculated and put into the income statement. So we have to add them back to get the cash from the profit. And next we have the increase in current assets. That's a decrease, represents a decrease in cash, 29,500. The increase in trade payables would be opposite way around to the increase in the current assets. So we add it. A decrease in the accruals, we will minus that, and when we add the entire column, we'll get the net cash flow from operations being 102,850, and it is an inflow. Okay, if it was an outflow, we'll put it in bracket. Okay, let's move on to the next section. Investing activities. In this section, we have usually the investment in non-current assets, and if we have any investment that we make in other companies or other businesses. Okay, so the sale of the equipment that involved non-current asset, we sold it for 40,000 in cash, so that would be an inflow of cash. The purchase of the equipment, 143,600. You could want to check that back, and the 85,000 that was introduced to buy more equipment would give us an outflow of 228,600. And when we add those two together, we get a net cash flow from investing activities of 188,600. The financing activities, and these usually revolve around what takes place in our long-term liabilities and in our capital account. And first, we paid interest of 22,800, and that would be on a long-term loan. So that's an outflow of cash. Then we have the drawings by the owner. That would be 21,450, another outflow of cash. Then we paid part of the loan. It was 140,000 in the first balance sheet, and then we have it at 125 in our balance sheet. So that gives us a difference of 15,000 would have been paid. Then we have the owner introducing 85,000 in capital into the business as a financing activity, but this time it's an inflow of cash. When we add these together, we get a net inflow of $25,750. Now, continuing into the reconciliation here, when we add the other two activities together, the net cash flow from them, and this cash flow from financing here, we get a decrease in cash of $60,000. And the balance brought forward is 45,000 that we had in the note, the additional notes, 45,000. The balance carry forward is in the balance sheet, which will give us an overdraft of $15,000. So that brings us to the end of this part of the question. We'll move on to the next part. We have here part B, two independent scenarios, and we are asked to discuss the proper accounting treatment of each, including any required disclosures according to IFRS for SME Section 21, provisions, contingent liabilities, and contingent assets. Give the rationale for your answers. Right. So, if you have never read this section, you should do is pause the video, go get your textbook, and read up on Section 21 IFRS for SMEs. If you don't have a textbook, you can go to Google and type in this same thing here and put PDF after it. It will give you a PDF file with the provision, contingent liabilities, and contingent assets, how to treat them in the accounts of small and medium-sized enterprises. Okay, um, I have already done that, so I will continue on with the video. But if you do not do that, you will not know what I am talking about in this video. Okay, if you have never read that section of the IFRS, you would not know what I'm talking about. Okay, now I have here summarized in this diagram here how to the accounting treatment for contingent liabilities and provisions. It depends on their probability. The accounting treatment depends on their probability. You start in the middle here. If the liability is reasonably possible, then you will make a note in the account, in the financial note to the financial statement. If it is reasonably possible, that means it's around 50% possible. If it is probable, that means it is greater than 50% probable, and you have to make an accrual in your accounts first. Okay? And if it is remotely probable, then that means it's less than 50%, and you can ignore it, or you could still make the note in the financial statement. Okay? Right. There is other condition that you have to ask that we'll be asking in the other two scenarios when I look at. We look at scenario one. In August 2015, a worker was injured in a factory in an accident partially due to his own negligence. His worker has sued Rooney Company for 800,000. Legal counsel believes it is reasonably possible that the outcome of the suit will be unfavorable, that is, the company will lose the case, and that the settlement would cost the company between 250,000 and 500,000. Okay, so let's invoke our chart here. Right, it says it is reasonably possible. Okay, so it's fall here, and we would ask the question. It is a present obligation. It is the result of past events, and it is reasonably possible. So, all right, we know that we could provide for it. or in this case, we make a footnote or a note to the financial statement for the amount. A worker has sued Rooney and Company for 800,000. Legal counsel believes it is reasonably possible that the outcome will be unfavorable and that the settlement would cost the company between 250,000 and $500,000. Okay, notice I use the same terminology that I got here, right? You could do the same as well, right? So you have, in order for it to qualify as a provision or contingent liability, after reading the IFRS, you would see that it must be a present obligation and it must be the result of a past event. And then it must be reasonably possible or probable or remotely possible. Scenario 2, a suit for breach of contract seeking damages 2,400,000 was filed by an author against Early Company on 4th October 2015. Early legal counsel believes that an unfavorable outcome is probable. A reasonable estimate of the reward to the plaintiff is between 600,000 and 1,800,000. The potential damages are best reflected by the estimate. Okay. Again, we bring up our chart and we realize it's a present obligation. We look at the dates and it's a result of a past event. Somebody did something in the past and it is probable, right? It is yes, probable. So we will have to accrue for it here. That is, we will make our journal entry. Okay, so our general journal would we would debit the profit and loss account and credit provision for loss on keys. And this provision here would be liability in case. Right now, the estimate is done by taking these two figures, an average of it of 1,200,000. And we are dealing with some current and long-term liabilities on December 2015. The liabilities outstanding at Marin Corporation included the following. And we are given four liabilities and plus another situation with some common stuff. Instructions: prepare a partial balance sheet for Marin Corporation showing the manner in which the above liabilities should be presented at 31st December 2015. The liabilities should be properly classified as either current or long-term. Appropriate note disclosure should be included. Right? So we have here a note payable to National Bank of 300,000. We will head up our answer. Manning Corporation balance sheet extract as at 31st December 2015. The current liabilities section and the non-current liabilities section. So the note payable is payable in 2017, so that more than a year away from this balance sheet date. So we will have that in our non-current liabilities section. Okay. Then the next one is cash dividends on common stock declared on the 15th December 2015. 60,000 payable on the 6th of January 2016. So this is just a few days away. So we have to put it under current liabilities. And next item, note payable to Admire State Bank, 470,000 due on the 6th of January 2016. So this again falls on the category of the current liabilities. And serial bond 1 million, of which 250 is maturing during 2016. Only part of it is current and the next part is long term. So we put the part that is current on the current liabilities and the part that long term on the long term liabilities. So we have another item here on the 5th of January. This is post balance sheet event occurring after the balance sheet date. 40,000 shares of common stock will be issued for 350,000. 300,000 of the proceeds will be used to liquidate the note payable to the National Bank, right? So the item that this affects in the is about is this here, this 470. It's giving us additional information after the balance sheet date about how they're going to liquidate this here. So we could put a note in our financial note to the financial statement. On 5th January 2016, 40,000 common shares will be issued for 350,000. 300,000 of the proceeds will be used to liquidate the note payable to the Third National Bank. Okay, so this item concerns this here, and we need to note it in the notes to the financial statement. But that would bring us to the end of the module, and I hope it was helpful to you, and you will give it the thumbs up. And see you in the next video.